you. We obviously saw a great November, all three indices rallying. Coming up in the December meeting, almost everybody believes that we're going to see a pause. Does the rest of this rally, this possible year-end rally, does it depend on a dovish Fed? The commentary from Jay Powell.
You know, I think that's what the market's pricing in, Frank. It's a really good question. I know we're going to hear from him today. I don't think his position's going to change today. He has been hawkish. He has wanted to leave the possibility of one more rate hike on the table because he wants to make sure that inflation is in fact squashed. It's obviously coming down. If you look at the core PCE, it was 5% at the start of this year. We're down to 3.5% now. So we've made some really great traction there. You see the job market softening. So that's why the market is pricing in peak rates are here. The Fed is done. But the expectation to hear those words out of Chair Powell's mouths, I think that's where the rubber is going to hit the road at this December Fed meeting. And so, you know, if the market's pricing that in, we might be disappointed, and that could result into a little bit of angst in the market mid-month.
So, Robert, same question to you. I mean, we've seen throughout the year that the market hasn't really believed what the Fed has said. Actually, just earlier this week, our Steve Leisman spoke to Richmond Fed President Tom Barkin, and he said, you know, inflation is stubborn and that the market is kind of hearing what it wants to hear, and the Fed's keeping all of its options on the table. In your mind, how much of this rally is dependent on a dovish Fed?
The rally actually started a few weeks back when the 10-year Treasury sort of topped at 5%. So the bond market is indicating we have a slower economy ahead. It's also indicating the potential for the Fed to be on pause. Now, the Federal Reserve chairman has a tough job. He has a tightrope to walk because he has the first wave of inflation coming down. So he can't declare victory, but at the same time, he also has to say, hey, listen, let's talk tough, but maintain higher for longer as long as they can hold that line.
All right, so obviously you're mentioning bond yields right now, Robert. So right now, we're seeing them at about 4.31 right now, about 70 basis points lower than their peak this year. As you mentioned, it's about 5%. Where do you see bonds going from here, and how does that impact the markets?
Yeah, fixed income has been the story for 2023, with the sideshow being the equity market. The 10-year Treasury has been the show. So do the bond vigilantes actually, are they running ahead of the Fed? The question is, it remains to be seen, because as we know, historically speaking, the first wave of inflation is coming down. But historically, inflation comes through two waves, about 87% of the time. So the Federal Reserve's got to maintain a hawkish tone. The bond market's going to play that tug of war, and the 10-year Treasury is still going to be the story for 2024.
All right, so if the 10-year Treasury continues to be the story for this last month of the trading year, Lindsey, how would you play things? Where are you going to put money? A lot of people are talking about the market basically broadening out, but would you stick with what's been working all year, or are you looking for new opportunities?
Frank, I'm going to stick with what's been working, because I think there, despite the bullishness that has come back into the market when you look at things like the AAII survey, and obviously after a 9% run in the month of November, people are feeling better about things. But the reality is, when you think about the economic environment for 2024, people are still uncertain, and there is a defensive tone when you talk to a lot of big investors. So I'm going to stick with what's worked. And if you, even when you look at the month of November, the stocks that performed the best were technology, communication services, and consumer discretionary. Seasonally, those usually perform very well in the month of December as well. And so for those reasons, I think the defensive nature in some of those tech sectors, the AI boom, the reliability of earnings, those things are going to continue to drive those sectors going forward.
So, Robert, I think you agree with Lindsey. You gave us a couple picks. Seems like you're also sticking with what's been working so far this year. Your picks this year, Eli Lilly, Microsoft, and Amazon, all doing very well.
Yeah, we believe in the AI space. I mean, Frank, if you believe in the AI space, here's what you're looking at. We know these stocks have run up, but if you think about the total addressable market, right now it's a $150 billion market globally today. It could be 1.5 trillion by 2030, which could be accretive to the global sort of savings or contribution about $15 trillion. So there's a lot of efficiencies at work in the AI space, especially with the wage pressures and everything. We're talking about the Fed right now. The AI story is still here here and has a lot of room to run. And then we like Eli Lilly. Again, it's another growth space. Even if we believe that the economy is going to slow, Eli Lilly is one of those growth stories that we believe it could double from here. It's a $6 billion market cap today, could be $100 billion in terms of the war on weight loss drugs by 2030 once again. So you want to insulate yourself from what potentially could be clouds on the horizon, maybe a slower economy, but believe in stories like AI or even the weight loss drug war.